Today, I want to explain why these hedge funds are collapsing left, right and centre. Over the last few months, Biotech Moose has added tons of hedge fund collapses to his wall of shame. And today is no different with another hedge fund biting the dust. So stay tuned and let's make some money. And now I'll dive straight in with the key information. So, Macro Hedge has tweeted saying hedge fund Brevan Howard is cutting 10% of its trading floor amid losses. And they've added saying one red day and a hedge fund is blowing up so bad they're having to lay off its trading floor due to sizable losses. So let's talk about why these hedge funds are losing so much money, enough money to be laying off staff over losses after just one single red day in the S&P 500 or in the market. You'll recall a few videos ago I spoke about how hedge fund leverage has reached new highs. The average hedge fund is leveraging its money by at least 3 times. Okay, if a hedge fund has $50 million of cash or $50 billion of cash, they're not just buying $50 million or $50 billion worth of stocks, they're buying $150 million or $150 billion worth. And then when that stock or when those stocks drop by 10%, they're not just losing $5 billion, 10% of their cash, they're losing $15 billion, which is a significantly larger portion. And remember, 3 times is just the market average for these hedge funds. Many hedge funds out there are leveraged 5 times, 7 times, even 10 times. And therefore, when a stock drops by 10%, they're not just losing 5 million or 5 billion, 10% of their cash, they're going bankrupt, losing 100% of their capital. Again, similarly, we covered George Weiss not too long ago, who's recently also just closed down his hedge fund over losses. And the interesting part is that actually George Weiss searched for a buyer before shutting down his hedge fund. He obviously approached other hedge funds and said, guys, I've taken on some losses, but I do have some good stuff. I've got some good stocks and I do have some remaining capital. Does anyone want to buy me out? But clearly these hedge funds looked at what toxic derivatives he had, which massive liabilities and massive short positions he was holding. And they said, no thanks, we're not going anywhere close. Clearly George Weiss must have been holding some really shady stuff, some really dodgy stuff, if not a single other hedge fund out there wanted to buy him out. It says before calling it quits, hedge fund chief George Weiss searched for a buyer for his $3 billion firm, talking to prospective suitors over the past year, including Millennium Management. It says his hedge fund had lackluster returns for years and was looking for a deal. Apparently it only sank 0.6% in 2022, but yet the firm needed to close down. Clearly George must have been holding some really toxic liability positions that he could not close out of, and that's what forced him into bankruptcy or forced him into a shutdown. Apparently he only recognised losses of 0.6%, but I guess his unrealised losses must have been significantly larger, so large to the point no one wanted to buy the fund. And what's also very interesting is that hedge funds and private equity firms are now aiming to temper the SEC's WhatsApp probe. I also wanted to quickly go through today's fast-moving momentum news play on VERB, which ran for 121%. You can see we waited for the pre-market high, we waited for the break of the pre-market high, and the stock continued running all the way from 41 cents per share to 92 cents per share. John bought in at 52 cents and sold at 75 cents. Firefly sold half of his shares for approximately 50% gains and sold the rest for 100% gains. CSUMS made $219 of profit, and Arif bought in at 45 cents and sold at 63 cents. On top of this, Xavier for the week is up $631 on his small account, showing these trades don't just happen once off rarely. These kind of trades happen every single day and very few losses happen in the group. So guys, if you want these 120% gains, be sure to join the Millionaire Mindset Trading Group using the link in the description below. These hedge funds are trying to survive a few more weeks or a few more months without being caught for their crimes. And they're saying, SEC, you've investigated these banks over dodgy WhatsApp communications, but you've gone far enough. You can't investigate us for our dodgy WhatsApp communications. Basically begging the SEC not to investigate these shady goings on at these hedge funds and read through those WhatsApp messages. I always go by the general rule that if somebody is innocent, they've got nothing to hide, and if they're specifically trying to hide something, it's most likely because they're guilty. The article even says specifically that Citadel has made the case to resist, urging that the rules requiring brokerages to keep records don't apply to hedge funds and private equity firms. So Citadel are saying, SEC, you cannot read our WhatsApp messages because the rules are different for us and we don't have to keep them. As I said, surely that on its own suggests a matter of guilt if they're trying to specifically keep their conversations private. It says top hedge funds and private equity firms like Citadel, KKR and Co and Blackstone are discussing ways to blunt any fallout from the SEC's crackdown on the financial industry's use of disappearing messaging apps. And Ken Griffin's Miami-based fund is still prepared to fight the regulator in court if necessary. So that to me is absolutely massive and proves that we are right and have been right all along. If Citadel had nothing to hide, they'd hand over the data, easy peasy. But the fact they are trying to keep it secret and they're willing to fight the SEC in court over these WhatsApp messages, to me, shows guilt. And Frank's Place has tweeted saying Citadel and its peers, such as Pershing Square Capital, are indeed facing increased scrutiny. It says the concerns arise from the significant profits and the dominance of large multi-strategy hedge funds in the market. These firms have been successful in recent years, leading them to managing a substantial amount of assets with high levels of leverage. Saying this has caused unease amongst regulators, investors and traders due to the potential risks associated with crowded trades and the sustainability of their business models. And said the scrutiny is part of a broader conversation about the role and impact of large hedge funds in the financial system, especially when they're piling into the same trades, which could lead to widespread losses if there's a rush to exit these positions simultaneously. So this article is saying these hedge funds have only been successful due to using massive amounts of leverage, and these hedge funds are all crowding into the same trade. And if there's a rush to exit these positions simultaneously, be it exit long positions in the event of a crash or exit short positions in the event of a squeeze, it will lead to widespread losses. And what's interesting is these profits are arising concerns, maybe because the profits have been generated illegally or unethically. There finally seems to be more and more crackdown on these hedge funds, private equity firms and large institutions and market makers. And it seems they really are setting up for their own downfall by using such high levels of leverage, congregating in the same trades, and effectively being in positions which they cannot close out of. Because obviously, even if one of these hedge funds did want to close out of their short position, it could lead to a rush to exit that position for all of those hedge funds, causing widespread losses. And obviously, widespread losses for them equals widespread gains for us. On top of that, you may have seen the Palantir CEO, Alex Karp, talking about short sellers on CNBC the other day.
The lines of cocaine and away from these short sellers who are going short on a truly great American company, not just ours, but just love pulling down great American companies so that they can pay for their coke. And the best thing that could happen to them is we will lead their coke dealers to their homes after they can't pay their bills. And that's like one of my...
Surely all short sellers...
Yeah, well, go ahead, do your thing, we'll do our thing.
The CEO of Palantir is there suggesting these short sellers just try and push down genuine American companies to feed a potential drug problem. And is also suggesting that it won't be long until these short sellers are liquidated and need help paying for their drug bills. I love to see CEOs pushing back and fighting back against these short sellers by improving their companies to grow the company, grow the stock price, and eventually liquidate those shorts. 741 Trey has also added a couple of screenshots from the proposed amendments to the liquidity risk management and stress testing frameworks, saying the DTC is requesting to withhold certain reporting threshold breaches and liquidity shortfalls during market stress tests by handling them in-house. Now what this is basically saying is the DTC, during a period of heightened volatility, aka during a squeeze or market crash event, wants to remove those liquidity risk tolerances or margin requirements and handle margin calls or the liquidity provision in-house. aka instead of firms having to meet a specific liquidity requirement or margin requirement, and if they fail that margin requirement they get margin called, the DTC wants to handle liquidity in-house and hopefully avoid these hedge funds suffering a margin call. Basically the DTC is now worried about margin calling hedge funds because they know how much of a knock-on effect it will have to other hedge funds due to all of this leverage. They're effectively trying to backpedal rules that were put in place after 2008 to obviously stop 2008 from happening again. Margin requirements are put there for a reason because if a hedge fund cannot meet its margin requirements, it poses a risk to the remainder of the system and therefore needs to be margin called, liquidated and closed down. And the DTC now wants to remove these margin requirements. Yes, removing margin requirements in the hands of a responsible person likely wouldn't cause an issue, but removing margin requirements for these heavily over-leveraged, risk-taking, stupid illegal hedge funds will crash the entire system. I personally don't agree with these proposed rule changes as I think it's ridiculously risky because these hedge funds can't be trusted, but at least if they do remove these margin requirements, when all of the hedge funds breach their margin requirements and the entire system collapses, it will result in a stock market crash and the AMC squeeze. Again, by removing these margin requirements, it doesn't end the chances of a squeeze, it just kicks the can for a few more weeks or a few more months until all of the hedge funds blow up, not just one individual hedge fund blows up, and the entire system comes crashing down. And we know exactly that will happen because as Stonks Batman has tweeted, he said between December 15th and February 29th, short interest has only gone up. AMC's legally disclosed short interest has increased by 40% since December, going from 18 million shares now up to 31.75 million shares as at the end of February, and in March this has increased again, now up to 34 million shares. Shorts have doubled their short position in AMC since December, both likely the legally disclosed short interest and the illegal synthetic short position too. So guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell because that way you'll be alerted when I upload a new video. Cheers.